Well, hello and welcome to the Mutual Fund Show. I'm Neeraj Chana. On the show today, we'll discuss 2 or 3 very important topics. I think the million-dollar question is, of course, whether is this a good time for somebody who is not a buy and hold investor for her or him to exit out of small cap funds, whether partially or fully, why or why not. We will also talk about something that a few of you asked us on Twitter, which is this booster STP concept. And I know an individual fund may have launched it, but I guess the concept, it can be replicated manually as well by people if they want to. So we will talk about whether you should be doing that or no, and what circumstances should you be doing. And there was some bit of chatter in WhatsApp groups about the moves taken or the lack of them by SEBI on the revised risk management framework. We'll talk to 2 of our experts on what they make of those moves. And our guests today are Prableen Bajpai and Kshitiz Mahajan. Both of you, thank you so much for taking the time out. Very good evening.
Good evening, Neeraj. Good evening, Prableen.
Yeah. Okay, so great having both of you. Let's start off with the first topic at hand. And ladies first, Prableen, I'll start off with you. And I'm not a sexist by any time, remember that. But yeah, the question that is probably top of mind of everybody is whether yahan pe should I book profits, and more so at the broader end of the spectrum. So for a mutual fund investor, obviously the question that comes to mind is that forget large cap funds, but from my mid cap funds, from my small cap funds, or if I have a flexi cap fund which has got a higher exposure to small caps and mid caps, should I take some money off the table, whether partially or fully? What are your views and why?
Thanks, Neeraj. Now, this one is always tricky to answer. So I think one word answer would be yes, and I'll give you some data here. See, ideally, when we say that whether you should be booking, profits or not, it actually depends on how far your goal is. So if your goal is, of course, like let's say 2 years from now, definitely, anybody should be booking their profits. If the goal is little away, let's say, 8 to 10 years, of course, they don't need to worry. But of course, depending on their own personal risk appetite and other things, partial profit booking can be done. Now, since the lows of March 2020, we've seen the small cap, BSE small cap index up by 213% till yesterday. And the Nifty during the same time period has been up by about 133%. So of course, it's a huge gain that the small cap index has made, and the small cap indices, they actually move in the same trend. The gains are really large, and the fall is also quite hard. So we've seen falls up to 72% in 2008, and then 40% subsequently in 2011. So 2 things here, Neeraj, when we're talking about whether they should be booking, if you look at statistics, valuation wise, of course, PE is not the only criteria that has to be seen, but that's the only way of keeping your emotions slightly aside. So PE and, PB, or price to book value, these 2 matrices can be seen. And going by these 2, there is a bit of overvaluation currently. And I do feel that, at the PB of 3.02, it is currently for the year 2021. It's an average of the months. It is much above 2017. It was at 2.37 when, we did see a small cap rally. So going by these figures, the data that we have, yes, some profit booking can definitely be made. Having said that, one more thing, Neeraj, that, all this is actually for the index. So we are talking in relation to an index. An index is not a very true representation, especially in the small cap space where there's a huge scope for, stock picking. And the individual data, scheme-wise must be analyzed by the investor, him or herself, or by their advisor before taking a call, because there can be a huge gap there between, the PE for the portfolio of a certain scheme and what the index is showing or the broader markets are showing.
Valid points all. And Kshitiz, let me come to you. You guys are known to be all-out equity people. What is your sense here? And again, the question would be why or why not?
So I think that's some valid data points have been presented by Prableen. Neeraj, my take here is that when you talk about somebody who's not buy and hold, forget about small cap, mid cap, or any cap is not for that person. Equity, the people keep on talking about that what type of return they are generating, but people don't focus on T. That future value formula, which is equal to present value bracket 1 plus R raised to power T. The focus should not be on R, it should be on T. So somebody who's not buy and hold, let's say for more than 5 years, 7 years, then small cap for sure not. If he is there in that investment, last 1.5 years have been really a dream run for small cap sector. Having said that, they have not done well since 2017 December onwards. They have not done well at all in last 2.5, 3 years. So yes, one can look at moving out of small cap, but then depending on what type of goal he want to achieve with this money. One is wealth creation, and he don't want to have a lot of risk on the table by investing into small cap. He can move to a multi-cap fund or maybe a large cap fund. But if he has a limited time frame goal, let's say the goal is for 3 years, then rather than parking into any debt funds or debt instrument, he can move to balance advantage fund. The beauty of all balance advantage fund right now, except for the Edelweiss, where they have a daily, averaging of equity debt allocation, other BAFs are at almost 33-34% of equity allocation. So if market will fall, automatically your equity participation will increase. And we all know there are two expanding asset classes, equity and real estate. Debt will not yield you much more than 5.5%. So one is this, you can look at BAF. Second is, if you have a horizon which is close to 5 years, then move to a multi-cap fund or a large cap fund. Otherwise, if you have horizon which is less than 2 years from here onwards, then my suggestion here is that just move out of equity as an asset class, because what we have seen in the last 1.5 years is not going to get repeated in the coming times. So one should be aware of that small cap investing, the bracket which regulator has given, that from 150th company to 250th company, that's how they have given the bracket. Sorry, it's 250th company to 500 company for a small cap investing. So market cap begins from 10,000 crore up to, most of the small cap they invest up to 2,000 crore. So there are good businesses, there are good funds in that basket, but you should have time which is in excess of 6-7 years. Then you can look at maybe 20-23% compounding on this sector.
Yeah. Viewers, I believe last episode we have kind of established that buy and hold need not necessarily work. If you start your investment at certain years, because if you are an investor who regularly needs to take some money out for expenses, if you are not in that mode wherein you don't need the money out of the equity investments, then buy and hold will probably work in almost any given year point of time if you look at a 20-year horizon. Otherwise, at some point of time, it cannot work too, and which is why this question on the small caps was very important. Now, Kshitiz, one quick follow-up to you. What if you believe, the question essentially was that the person who is investing, she is not a buy and hold kind of an investor, in which case, are there still small cap schemes or small cap funds which are doing their work in a risk adjusted fashion, wherein even at these elevated levels, it might be prudent to keep some money on, not maybe the entire corpus, but some money can be kept invested because it's futile to time the market.
So yes, Neeraj, first of all, let's understand what small cap regulation is. That if you are investing 100 rupees of small cap, 65% in a small cap fund, 65% need to be in small cap space only. But the remaining 35% can shuttle between your large cap or a mid cap basket also. So yes, there are certain funds which have grown in size, and I will like to take 3 names especially, which is DSP small cap, HDFC small cap, and your SBS small cap, where, for one thing is that they have a lot of number of stocks in the basket to diversify the risk. Second is they have good allocation towards the large cap and mid cap space also. They're using it well. So, I see that this China plus one, or let's say interest rate which are low, and India focus, growth orientation of the government about how they want to go about it, and a lot of other things which are moving this entire markets in a very good direction. Having said that, market will remain the same, I can't say, but if you have some time on your side, then maybe you can book the profit, but keep the money intact in this space, because this space is very much capable of creating 3 to 4% delta over your large cap basket. So yes, I agree with you on that.
No, I was asking for your opinion, really was not giving one.
And I'm saying that so because what you're saying, I am on the same page.
Okay, yeah. But usually, I mean, on this show, I usually stay away from giving too many opinions. I was just quoting something that we got from the show that we did the last week. And the
Right.
data point suggests that maybe buy and hold may not be the most optimum strategy for somebody who wants to take money off almost every year. But
Right.
probably just on this very point, a quick follow-up. Are there funds that you, at the small cap end, where you believe that, I mean, I'm not asking you to name all. Again, I'm sure Kshitiz did not name all the funds that he likes. He gave an example or two or three. Maybe there are more that he likes as well. But are there funds that you believe are doing exemplary work and people should keep them in mind, whether if not now, then at maybe lower NAVs if the markets were to correct?
Yeah, Neeraj, why not? I think small cap is a great space to enter when markets are really down, because the fall is so much more actually, and it can really work. So some of the funds I think investors can keep in their minds are probably the SBI small cap. It's been a very consistent performer. Also, when it comes to small caps, I feel that I personally would avoid funds which have a very shortest kind of a track record, because it's really important to see how the fund has fared over the different cycles. So if it's gone through the 2008, 9, 11, these time periods, it will be really good. So funds with longish time that they've covered. DSP is one fund, and I would say Axis. I think these three, currently.
Okay, a couple of commonalities out there between Kshitiz as well as Prableen, which is the SBI small cap and DSP small cap. Interesting. By the way, viewers, remember, these are not the only funds that they would recommend. And if you are wanting to buy, please do your own due diligence. If you have an advisor, please talk to your advisor about these funds as well. Now, the second point, Kshitiz, so many people actually wrote to us. One person in particular tweeted to me as well about this this booster STP thing that I think ICICI has come out with. Can you tell us what this is about? Is that a good strategy? And throw some light on it. And what kind of investors is it suited for?
So Neeraj, your show is being watched by a lot number of people. So just to make things easy for everyone, there is a different platform through which you can invest in equity in a staggered manner. One is a SIP way, which is a systematic investment plan. Money gets debited on a defined date from your buying. If it's not a bank holiday, one day after that. And every month, let's say 5,000 rupees keeps you going in a scheme which you define. The other way is a systematic transfer plan, which is called STP. Now, this is not a very longish process which you go for. It can be for 6 months, 10 months, or 12 months, or let's say maybe for a couple of years. You put money in any of the debt schemes, let's say liquid fund or ultra short term or whatever fund scheme you define, and on a monthly basis, on a given date, money gets switched from one liquid fund to the given equity scheme. It can happen to a debt scheme also. The facility is for across the schemes. So this is called STP. Now, normally, if let's say I have put in 12 lakh rupees and I go for, let's say I want to divide my allocation at these levels in next 12 months, I will say 1 lakh each, depending on, and then there will be some surplus money because of that liquid money appreciation will remain, and we can switch later on. But this is a very beautiful concept which ICICI has come up with. It's called Booster SIP. And it works on a model which is called Equity Valuation Index, EVI, which is on the basis of your price to earning, price to book value, your GSEC into price earning, and market cap to GDP. There are 4 parameters on which it works. And all these parameters define a range at which equity valuation is. And it varies between 0.1 to 5. So let's take, for example, if the same example which I'm saying that 1 lakh every month will go. If you want to put this money right now, the valuation matrix will say just put 10,000 rupees right now, not 1 lakh rupee, because markets are at very high valuations. Same thing, you should go back to March 2020, and they do this on every 28th. They will say, okay, put 2,80,000 in March on March 28th, because valuation were very cheap. And because 24th was the day when market hits its low, and then it recovered a bit. On 28th, the valuation was this. Now, rather than just doing in a very mechanical way that every month on 28th, 1 lakh rupee will go, what this allows customer or allow any investor to do is to encash on the markets, given market values. So if I'll come to you, Neeraj, now you are a very knowledgeable, or you understand equity very well person. Let's say if you are not a part of this industry, I'll come to you and say, Neeraj, market is down. We can switch the money now. At 7,400 level, how many people were actually participating in equity market? You will not do. But if there is a process which is set, because there is no emotion in that, there is a valuation matrix, automatically, rather than 1 lakh rupee, your money got deployed at 7,800 level of Nifty, 2,80,000 rupees. This is the best thing where emotion doesn't play a role, and automatically, depending on the matrix, value matrix, your money keeps on going in an equity portfolio. So this is about how it works. And I think it's a beautiful concept which ICICI is coming. I will urge other AMCs also to start this, because this can't be that they can't do this, but it's actually very, very good concept.
Yeah, and which is what I was saying, I think maybe people can do it on an individual basis too, but I think emotions play a havoc out there. Probably you want to add something to this, and of course, also couple that up with what kind of investors would this be suited to? I mean, specific kinds, or is it for everybody?
Yeah, absolutely. Neeraj, people who want to invest right now, somewhere there would be an hesitation that, markets are at all-time high. I think this is an amazing concept because, Kshitiz said, it takes away all the bias, basically the emotion, the behavioral bias it goes. Second, that, now there is an issue with switching money. If I have to do it at an individual level, the day I make the switch and the day I get the NAV, there's a lag and all. So, all that is taken care of. We are all busy in our lives. So on a day-to-day basis, if somebody is actually tracking markets and trying to make that shift, it may not work. So the process is automated. It's, I think, interesting, and it also can extend the tenure if there is not enough opportunity. So it's not like within 20 months the money has to be deployed. It'll extend the tenure as well. So even I would agree, I think all AMCs as a standardized, as a tool, it should be there. This kind of a mechanism to move into the markets when valuations are more lucrative. I think it can really help. And it's an interesting concept because EVI is also based on 4 different parameters. So it's not only on one thing, it's an equal weighted thing between those 4 parameters. So, the back studies they've done, actually, the testing, it does show that, they've been able to achieve about 2% difference in returns during the time period that ICICI had actually done the thing. So, second, STP, what happens, Neeraj, that we set an STP and we keep buying at higher markets. So, we just pick like it has to be weekly, let's say 20,000 or so. That doesn't happen. So you're not averaging upwards, at least.
Yeah, and viewers, maybe in stocks in which you understand the story, averaging upwards may be a beautiful thing. If you are a passive investor, then maybe what Prableen was saying, it could actually not be as productive as buying at the lower levels, and which is what probably this booster STP tends to do, buy more at lower levels. I think that was the gist. So Kshitiz, invest. Yes, please.
Yeah,
please,
I'm
Kshitiz.
saying just to add to what you said, in stocks, I think people should have now, target of not price but number of stocks. With good businesses, how much percentage you are owing? It can be in bitcoins. Normally, when you buy 1 lakh of a bitcoin, it comes 0.0000 and then some number. So I think the best part is how much business you owe that if you like that business, and eventually it will pay out. The payout is going to be good if you have time on your side. Yeah, you were asking something.
No, I was just asking. Therefore, is the summation of this conversation is that it's a good scheme and people should maybe take advantage of it?
I sincerely feel if you have a lump sum money to deploy and markets are where they are, and very rightly, put by Prableen also, rather than putting all the money in a staggered manner in a same fashion mechanically, 1 lakh rupees every month. Depending on the EVI, what value it throws, right now the value is 0.1. So your upward averaging is not happening. It is only 10,000 rupees which is going, and the market will fall. It will take care of the many things.
Got it. Okay. Thank you both of you for explaining that, because there's so many people wanted to know about this, and let's see if other AMCs follow suit. The last question really, and on this conversation today at least, was this whole thing done by SEBI, right, about tightening the risk management rules. Probably, what did you make of them? Was something too harsh? Was all of this leading towards more transparency? And is there more that could have been done but wasn't done?
Right. Neeraj, it's a very extensive 48-page document. So the gist of it...
It's why you are answering it and I'm not.
The gist of it, what I've understood, of course, there is a huge focus on, one thing which I really liked is huge focus on identification and management of risk. And they've actually spelled out all different kind of risk, right, from credit risk to liquidity to governance to even talent. So that when you have a person, an AMC even has to plan, who's going to be next if that person leaves or something happens. So there's a talent risk also. So they've, covered these different kind of outsourcing risk, financial, multiple risks, and they've given some interesting, solutions or proposals there. Some of them, of course, are mandatory. Some of them are recommendations. So overall, a lot of focus on how risk has to be identified. Also, of course, a lot of it has been there earlier also, gradually, because, in the last 2 years, SEBI has come out with so many circulars on, bringing in more transparency, increasing compliance, regulations. But it also again clearly spells out, the roles, the responsibility. So it's like very well defined. And simple things like, let's say, investor concentration or a distributor concentration for an AMC, those things also need to be tracked very, closely. So overall, I feel it will, AMCs are, as it is, very highly regulated, but I think it will further boost the kind of, protocols that they have. It will become more standardized across AMCs, with these mechanisms. So in total, I would say that from an investor point of view, nothing really much, that would change at their end. But of course, a lot of work that probably AMCs have to do.
Well, maybe most people will say, hey, that's all welcome, because eventually it will work for us. Kshitiz, your views here very quickly.
So normally we say that you go level 2. This is SEBI going level 3, and I should compliment SEBI. And very rightly put by Prableen. I'll not add that part which she has already explained. I will say that from investor point of view, his money is more safe, because every compliance, every operational part, every cyber part, whichever part is having a better, security, or maybe better, compliance risk officer attached to that, it becomes more safer. Second important part is, I think I used to work in Ultratech Cement. Gurmeet used to work in ACC Cement. So hum dono ka, for both of us, it's like, if you actually see a cement plant or any company factory, there used to be a lot of employees, but in sale, the total strength of employees is 10% or 8% or 12%. That's how it is. So AMC need to have a lot of people on their corporate office side, as well as on the manufacturing side, as well as on the risk management side, because this is the main thing which they need to understand. Return generating is one part, keeping client interest in all parts, whether on the compliance side or operational side, the type of stock which you are looking at, the type of succession planning you are doing for the company. Tomorrow, if any let's say CIO, the key man who's managing the show, leaves an AMC, what is going to happen then? So are you planned that? So that is something which they have defined. There needs to be a chief risk officer, CRO, and they have defined responsibility for each and every officer, CEO, board, CIO, at every level, so that it becomes more compliant, it becomes more robust in terms of its approach towards client, and client interest and money is in a better safe hands. So overall, this is a very, very welcoming step by SEBI.
Well, both of our guests are on consensus. So on that note, we'll thank both of them for joining us today and giving us this lowdown on 2 or 3 very important topics. Prableen, Kshitiz, thank you so much for being with us today.
Thanks.
Thank you, Neeraj.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.